Hello and welcome. Sean Allison here from Cashflow Options, ready to present this week's market update. Let's jump into it. We've done very well this week. If you got into any of the three positions that I mentioned last week, you would be sitting on some very nice profits right now. So we'll talk about that in a moment. Right now, the futures market is down only slightly, except for the Russell 2000. That's down by more than 1%. So this is showing us these four here: Dow Jones Industrial, S&P 500, NASDAQ, and the Russell 2000, showing us where the cash market will open. Right now, the Russell 2000 is down 1.13%. If we look a little bit at the market momentum, we can see that a month ago, that the number of stocks above their 50-day moving average was only just below 24%. Now it's just above 41%. So while it's still low, it certainly has improved. If we look at the actual chart, we can see that the S&P 500, the best gauge of the overall stock market, has been moving up and away, making new highs again. If we use our 92% accurate opening range, which is set on the first trading day of the month, which I've circled there, and then resetting on the third Friday of the month. So we'll be resetting this on Monday, and that will give us a new opening range. But for now, if you get it above those lines, it's bullish. Below the lines, it's bearish. In between would be neutral. So right now, we are bullish, no doubt about that. We are in bullish opening range mode. Regardless of what the headlines say, regardless of what's going on, the market right now is telling us via the charts that it is in bullish mode. Quite a bullish pattern as well. The market tried to fall. Sellers tried to take charge today, but then the buyers, should I say, fought back, and they put it all the way back up here, drove it all the way back to close right up here. So this is very bullish, almost a very good looking hammer candle there. And this is bullish price action. So above the opening range, bullish, strong candle there. Nothing bearish about that. Now, if we look at our workspace, that's the best gauge of the stock market in one hit. We can see right now that the transports, which were in a downtrend. Now, this is important because the transports lead the market by several weeks to several months. What does that mean? That means if it continued to move down in this downtrend, it was going to take the rest of the market with it. However, what's happened now is we've broken out of this, as you can clearly see, broken out of the downward channel above the 21 EMA, which is the first time in quite some time, and continuing to move higher there. So this is a bullish development in transports and could be a strong sign for the markets going forward. Russell 2000 is in sideways trading range, not doing a lot. NASDAQ still looking very strong, nothing bearish about that. We've already spoken about the S&P 500 and the industrials. We're in a pretty tight trading range. They've now broken to the upside as well. So the industrials and the transports have really got out of their downward channel and sideways trading range, and they've both broken to the upside. So that is a bullish sign for the market as well. So we'll be keeping a close eye on that. As far as the sectors go, the two largest sectors, technology and financials, they're still looking pretty good. Certainly technology is looking very strong. Healthcare looking very strong. Utilities as well. Nothing overly bearish right now with the overall market. So that in a snapshot. In one sentence, right now the market is moving up. There's nothing to tell me that it wants to move down significantly yet. We'll continue to trade what's in front of us. Trade what you see and not what you think. Bullish in the short term, okay? A new opening range coming up on Monday. So that's what's happening there. Now, as far as the positions that we got into last week, I told you all about this. I told you first about Microsoft. That's had a nice move up here, and I said, look, what I'm going to do is set up a vertical spread. I'm going to sell the 295, buy the 290 call option for the 17th of the 9th expiry. Now, we are up 44% on our money in a week. 44% return on risk in a week. How good is that? So that trade's working out very nicely. Apple, we're up 45% on our position right now. So this is fantastic. And keep in mind with Apple, we have broken out of a bull flag here. So we're really looking quite strong here. Very happy with the price action right now. 45% return and on Apple and 44% return on Microsoft. Happy days. The other one that I showed you was Pfizer. Have a look at that. Boom, to the upside, looking spectacular. So we're up almost 100% in a week on this trade. Now, while that sounds very good, and it is, right, almost 100% in a week, we have a dilemma. And this is a dilemma that most traders will face is, look, I don't want to get out of the trade because I think it's still going to continue to move up, for example, okay, if it's a bullish position. But I don't want to stay in the trade because I could lose it all, right? I could lose all my profit, go back to a break even, or worse yet, go back into a losing position. So I don't want to stay in because I'm scared I could lose it all. And I don't want to get out because I might make more, right? This trade still makes sense. So in a situation like this, where you've got a strong moving stock like this, still strong price action, sellers tried to drive it back down, and buyers step back in to close it up here, closing on or near its highs, good strong price action. So nothing right now would tell you to get out other than fear, right? The only thing that will get you out of this position. So you've got this dilemma. How do we get around this dilemma? Well, as option traders, we don't have this dilemma. Reason being, we can actually lock in profits and stay in the trade as well. One of the things you must be able to do to be consistently profitable, make money long term, is pay yourself when the market makes money available. When the profit's available, you need to reduce risk and pay yourself. Okay, very, very important. So we bought the 45 call for the 15th of October expiry for $2.33. That's now worth $4.65. So we've made a $232 profit per contract. So if you had 10 contracts, you would have made $2,320 in a week. So we've made a 99.5% return in a week, which is phenomenal, right? Now, one thing you could do is just simply close the trade out and be done with it, right? 100% in a week, I'm pretty happy with that. I think I'll just close the trade out. So that's fine if you wanted to do that. Or the other thing you could do is you could roll and stay in. So you could stay in the trade, lock in profit, and reduce risk. Okay, so let me show you how you would do that. We would close out the 45 call that we initially bought, like I've shown you here, for a $2.32 profit per share we're controlling. Then what you could do is you could buy the 50 strike call for the same expiry, same amount of contracts, 15th of the 10th, same amount of contracts for $1.78. So $2.32 we made in profit, $1.78 the cost of the new 50 strike call option. So we're rolling it up in strike price from 45 to 50. Then what we would have there is a 50 strike call. So we've still got a position here. We've still got a 50 strike call option out to the 15th of October. And we cannot lose. That's right. We cannot lose any of our own money once we do this. Okay. So we actually have a $54 profit per share, as you can see here. Okay. So if you had 10 contracts, you can put $540 of profit in the bank, and that is yours no matter what. Even if Pfizer drops to zero tomorrow, I will make $540 profit. And I'm still in the trade, and I could make even more money if it does continue to go up. That, to me, is some pretty smart trading. So I'm going to create a riskless, profitable trade. Sean, why is it riskless? Because none of my own money is at risk. I'm only playing with market money, right? Profit that I've made. Yes, I could lose more potential profit, but I cannot lose any of my own money. So it's a riskless, profitable trade, and I'm still in it with a 50 strike call. Stay in the trade, potentially make more trade, create a riskless trade in this case, no downside at all, and potentially a big upside. So this would be a very smart way of doing it as well. Locking some profit away in the bank and staying in the trade. Makes a lot of sense to me. And these are some of the things that we teach our members. And this is the difference between an amateur and a professional. An amateur will hold on to all of the contracts and just pray that it keeps going up. And you know what? Sometimes that might work. But over the long run, it is a recipe for disaster. I'm interested in high probability trading. So if I get a 100% return in a week, I am not giving that money back. It is unacceptable for a 100% return in a week to go back to break even or into a loss situation. Unacceptable. That cannot happen. Okay. So what we must do is lock in the profit, stay in the trade, and you're quite brave when you've got nothing to lose. We've got a riskless trade. I've already got $540 for 10 contracts locked away in the bank. That's ours to keep. And we're still in the trade. So you're extra brave when you can't lose, and we can stay in the trade with a high degree of certainty now that we're doing the right thing. Now, what I would also do, though, once I'd done that, is I would probably set my stop at the bottom of this prior candle. Okay, so the bottom of that prior candle there, which is 47.32, right? So if it did close below 47.32, I would then close the whole trade out anyway, all right? But we have the potential for it to move higher. We've locked in profit. We cannot lose, and let's just see if it wants to continue to go up, right? That's the smart way to do it. Now, as far as positions that go that are going on for this week, Palantir, PLTR. I like this as a long-term position. Some good volume coming into it recently, getting back up above the 200-day moving average. The long-term prospects for this company are very, very good. This is a company that, a technology-based company that I believe will do very, very well going forward. Okay. It was founded back in the early 2000s by the co-founder of PayPal. So this is a company that I believe, once it really starts to get its act together, is going to do very well. They're really, what they're doing is they're speeding up the corporate adoption of artificial intelligence software. So what they do is actually create a technological twin. Okay, so they're actually creating a twin of your current system that you have, your database. Okay, so for example, let's say, it's a little bit hard to explain, let's say that you had a wind turbine company, right? And you had wind turbines that were generating you energy, obviously, and making you money. How could you tell without a lot of expense, if I turn my wind turbines this much to the left, how much more energy would I get? Or to the right, or whatever. If I added solar panels, how much of a difference would that make? How much more energy could I generate? And that type of thing. With your electronic twin that is created by Palantir, PLTR, you could see all of those things in real time with a high degree of accuracy with very minimal cost. And it does a whole range of other things as well. Not my area of expertise, right? I'm a trader, but definitely I can see the potential going forward with this company would be massive. So after a big sell-off from 45 down here to lows of around 17, and now starting to move back up here a little bit, I think this could be a great long-term position to have. So what I want to be able to do is have a long-term position in this, and I want to be able to cash flow it as I hold the position. So I'm never interested in just buying a stock. To me, that is insanely risky, and I never do that. If I ever own a stock, I want to generate cash flow from it, and we have very strategic ways of doing that with options. Okay, so you've got to be able to reduce risk while you're in the trade. So that's exactly what we're going to do. So I like this one. That's a position that we're going to take long term. Right? Don't expect it to move back up to 45, within a month or two. It's a long-term position, but I'm going to cash flow it and reduce my cost basis in this position, and I do like it going forward. The other one here is Yum. Have a look at here, Yum Brands. Beautiful bull flag here, right? Nice looking bull flag, like I showed you with Pfizer, and that worked out very well. Not to say that this will, right? We don't know what's going to happen. Every moment in the market is unique. Anything can happen. But for me right now, let me just bring that in. We have a nice looking bull flag here, right? So we've got a nice looking bull flag. We've had a strong move up, sideways consolidation. Looks like it now wants to break out of that sideways consolidation. So I do like the look of this one. What I'm going to do is I'm probably going to do what I set up with Apple and Microsoft, where we're 45% return in a week and 44% return in a week. They're fantastic trades. So what I might do with this one, do a conservative strategy where I'll sell the 140, buy the 135, call vertical debit spread. So call vertical debit spread is just a fancy way of saying I'm buying and selling an option at the same time and creating a limited profit, limited loss strategy. Okay. Now, I'm going to sell the 140, buy the 135, which means there's $5 wide spread. Okay. So my potential upside is $5 per share I'm controlling. One option controls 100 shares. So you'd have to times that by 100, or if you had 10 contracts, you'd have to times it by 1,000. Now, so the limit debit of that 5 wide spread is $2. So that means my potential upside is $3. So what I would do with this is I would set this up with asymmetrical risk in my favor and make it set and forget. Sean, how could you make it set and forget and use asymmetrical risk? Well, what's asymmetrical risk? Where you're making a higher return than the risk that you're taking. The only way to make money in the markets. So what I would do is I'd buy it for $2. I would set a profit taker where I'm going to close it out. Well, my brokerage is going to close it out automatically for me. Once the value of the spread increases from $2 to $4, in other words, I've made $2 per share I'm controlling, it'll automatically close the entire trade out for me. And I'll also have a stop or a risk level put in at $1. So I'm buying it at 2, my potential upside is 4, and my worst downside is I sell it for 1. So if I bought it for 2 and I sold it for 1, I'd obviously be losing $1. If I bought it for 2 and sold it for 4, I'd obviously be making $2. So it's a 2-to-1 risk to reward set and forget type of trade. I love the sound of that, right? I love the sound of that. I accept the risk up front, set the trade up, and that's what I'm looking to do there. So anyway, I hope you guys found that useful. I hope you got something out of it. I hope you made some good money on those 3 positions that we had on last week. Our Lulu trade that we had on with a vertical debit spread, we're closing that out this week for a 10.2% profit. So another winning trade. We've had a huge amount of winning trades recently. And we're doing very, very nicely. So anyway, that's the positions that I'm looking at making money with this week. I hope you found that useful, and I'll talk to you again next week. All the best, and bye for now.